This is the S2G podcast, where we share conversations that help us understand how to scale the food, agriculture, oceans, and energy transitions. I'm your host, Tanya Bekritzes. In this episode, Sanjeev Krishnan gives us a window into his career evolution and his investment philosophies that have become core to our approach at S2G. As a reminder, this content is for informational purposes only. It should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security, and is not directed at any investor or potential investor in any investment vehicle sponsored by S2G. Investing involves risk, including the risk of loss. Specific companies mentioned in this podcast are for educational purposes and should not be construed as an endorsement of any kind. Please note that S2G may maintain investments in some of the companies discussed on this podcast. For more important information, please see S2GVentures.com/disclosures. We also want to clarify that the investors we mention in this episode are institutional investors. Sanjeev Krishnan is our co-founder and managing partner. He has brought so much of his perspective on the role of capital markets in igniting change to his work developing and leading S2G over the last decade. But we've never really dug into his story and the experiences that helped inform these philosophies until now. In this conversation, I had the opportunity to learn about Sanjeev's career arc. We talk about his formative years at the London School of Economics and his experience working in a telecom M&A group in Africa. We go into how he started a new life sciences venture growth strategy at the IFC, how he worked with early clean energy and electric vehicle companies at the Global Environmental Fund, and then met Lucas Walton and formulated the concept for S2G. I know, quite the journey. Sanjeev talks about how these experiences shaped him into the big picture systems thinker we know today. He shares so many key learnings from his expansive career that are relevant to investors and business leaders alike about systems thinking, designing fit-for-purpose capital, the art of focus, the importance of specialization, and finding opportunities to unlock business model innovation. And of course, the idea that companies can generate market rate returns while improving people's lives. Sanjeev is core to everything at S2G, from our mission to the Sanjeevisms that have permeated our vernacular. And this was a unique window into his background and philosophies. I hope you enjoy. Sanjeev, so excited to have you here in our new recording studio. Thanks so much for making time this early morning. We all know you as the co-founder of S2G, along with Lucas, but most people probably don't know a lot about your background. I know some pieces, but would love to know more. So I'd love to go way back. Tell us about your childhood. Where were you born? I know you grew up in India and then moved to the U.S., but what was that like growing up there and transitioning to the United States? Why'd you move, and what impact do you think that had on your life?
So I was born in India, born in Bangalore. We moved a lot around India when I was little. And then my aunt and uncle sponsored my family and I, and we got a green card and came to the U.S. when I was around 9. And it had, I think, a dramatic impact because I think you learn growing up, particularly this was sort of pre-liberalization of India, the importance of social mobility and the ability to kind of have economic free will. And India was at that point, and still is, still an emerging market. It was very impoverished, and it was very much a tightly controlled economy, not much competition, not much entrepreneurship or innovation compared to what it is today. And I think obviously at 9, I was just homesick. I didn't realize how much of an impact it had on me. But the other part of it is it does give you a sense of idealism because you grow up with people that are just by the accident of birth, in different circumstances than from others on the planet. At the same time, we're all pretty connected.
Well, we both grew up in Michigan, ironically. Both went to the same college, at least for a little bit. But tell me more about your journey there. Why did you end up transferring to the London School of Economics?
I was very interested in sort of development economics. And I moved to Michigan from India, and I really wanted to get out of Michigan at the time. And for various reasons, just was not a fit. And then when, the study abroad opportunity came up, I did it, and my friends described it as study abroad gone wrong because I just never came back. I transferred to London School of Economics. At the time, London School of Economics, the city was super compelling in terms of how global it was, and it continues to be. How LSE in particular had a real sort of differentiation in development economics, which I was really passionate about. And then it was also, just a lot of both fun intellectually and then obviously fun socially. So I just ended up transferring. And it sort of changed the arc of kind of my life, I think. And then I stayed in London, went to Africa, came back to London, then, moved to Washington, D.C. I don't think those events would have happened had I not transferred.
Yeah. Were there any formative experience during that period that set you off, obviously on a global journey, but that pointed you towards environmental focused investing?
I mean, at the time, I knew I didn't want to be an academic, but I really wanted to see how you change and develop economies. And so one summer, I was at a think tank, and that was interesting, but it showed me like the limits of government, the limits of civil society, and the real power of the private sector. And it was like the late 90s, so it was sort of this third way mentality of Blair and Clinton, and a lot of people just embracing business as both an opportunity or as a theory of change. The next summer, I did an investment banking internship in London and Paris, and it was right like 98, I think, 99. It was like the tech boom was just starting. And then I saw the dynamism of this innovation economy, the capital markets embracing innovation. And it was like, that's my vehicle, is really like business and finance. And I really continued to this day see capital markets and business as a vehicle for not just profit, but also and capital gains, but also making systemic changes to economies.
Starting out investment banking at that time during the dot-com boom and bust, what was that like? And I know you spent some time in telecom, even moved to Africa. Can you say more about that time period and what you learned from it?
Yeah, so I was in the tech, media, telecom M&A group at JP Morgan, 99, 2000, and I saw like the enormous climb, and so the boom and the bust. And I think it showed how capital markets can finance capital-intensive industries that have huge productivity gains and bring new ideas to scale. A lot of things that we talk about today when we talk about our work. But it took a combination of innovation. That stuff started 20, 30 years before that in terms of some of the routers and semiconductors and telecom equipment improvements. And then it took business model innovation, including the mobile phone industry, and then financial innovation, the amount of bonds that were issued to fund fiber and mobile telephony and all these things. And then I went to Africa because I was doing a lot of work with emerging market mobile companies. And I saw the huge transformation. I mean, economies were transformed, not just in like communication, but like women's health and safety. And so many things because, I mean, they basically skipped fixed line and went straight to mobile. And these companies were generating from zero to like significant EBITDA within 6 months. And so creating value for shareholders, having huge, not first order consequences, but second order consequences that ripple across the economy and frankly made these economies more productive, cheaper, faster, better. And I think that hooked me to like, I think what we call today impact investing. This was 2002 and I wanted to move from the sell side to the buy side. And so I started looking around and saying, where can I find work where I can make investments that have this dual purpose?
Yeah, say more about the business model innovation that enabled all that change in Africa at the time. What did that look like and how did it ripple out?
So, credit risk was a huge issue. Companies took billions of dollars of bonds or fixed income or equity to fund these mobile networks. And the concern was, could customers actually pay? And what the mobile operators did was say, you have to prepay in order to use it. So then they actually had a negative working capital cycle. The credit risk was effectively eliminated almost. And they were able to generate significant cash flow, frankly, in many cases, quickly. And so I think in the West, we don't do prepaid ARPUs, right? We get a phone bill every month. That business model innovation unlocked a ton of capital. And so I think it just reminded me that it's not just about the innovation that's important. When you have difficulty from a channel perspective or a concern around the channel adoption or channel credit, there's ways around it. And then that unlocked financial innovation to fund, which was a huge CapEx cycle, not just in the West, but all over the world.
You mentioned at this time you were really starting to think about doing something more impact-focused, more mission-focused. Where did you end up from there? And what were some of the key moments of the next step of your journey?
At the time, 2002, there was like not much impact investing happening. But I knew just what I'd seen of companies making real impact and change and profit that I wanted to pursue that. And at the time, the largest player was the IFC, which is the World Bank's private investment arm. So I think I cold called them maybe 6 or 7 times. And then finally got a role. And the first day on the job, they're like, we're starting this new group called Life Sciences, and it was a venture growth strategy, and they never had done that. And so we built out a venture growth practice in sort of industrial biotech, healthcare biotech, and then food and health biotech. And the industrial side was the first time I got exposed to the energy sector.
Nice.
And the environment in general, because a lot of that was post 9/11. There was a lot of interest in biofuel and what we call today precision fermentation. And then we made investments similar to what we do today at S2G, sort of venture stage, growth stage companies. And it was a combination of emerging markets and the U.S. We had a company that basically at the time, GSK had effectively a monopsony on Hep B vaccines. And we backed a business that basically deflated 80%.
Wow.
Respecting intellectual property law, just had better technology that was differentiated. And they then went to develop, I think, at least 10 to 12 other vaccines. And what that deflation did from a technology perspective allowed it to be covered in the global vaccine world more, both philanthropic, government, and frankly, the private sector. And I think they're credited with some really groundbreaking improvements in public health as a result of that. And I think it still continues to be a really great investment for IFC. I think they may have sold some of it, but EBITDA margins grew, EBITDA grew, revenue grew, and they were able to solve a public health crisis. And it just, again, further validated what I continue to believe today, which are like companies are a vehicle for so much change. And so I think you've got to obviously, in today's environment, be very akin to capital efficiency and shareholder value, but also your products, technologies, innovation actually can help improve people's lives.
Amazing. After that, you went to what is somewhat of an OG in the space, the Global Environment Fund, which was started in the late 80s, way before environmentally focused investing was fashionable. What were some of the things you focused on there, and how did those experiences shape your approach today?
Yeah, so before we call it climate tech or climate, we used to call it energy environment investing. And Jeff Leonard started a firm. Actually, even Jay Powell worked there, and lots of great people have worked there. It was the late 80s. And he was the one that originally taught me cheaper, faster, better. Like sustainability is about just things that you do with resource efficiency and productivity. So there are certain things that we do that's inefficient, and including in our food system, our energy system, our ocean system. Like I think in a prior world that may have been efficient, but in the current world, I think it's no longer as efficient. There was some formative experience I had there. One was helping a company called Greenco, which is now, I think, one of the largest developers in Asia and certainly in South Asia. They're now, I think they do much more than what they used to, but we found that they were doing small hydro and biomass, and then they realized that they needed to pivot to wind. And I think now they're doing a combination of that, but also green ammonia and industrial. So it's a company that's constantly kind of evolving because, frankly, the market is always evolving. And I think they've grown significantly. And I think it's because what was taught me there was, one, the access to capital in a capital-intensive industry is a core competency that you need to understand. Two, as your second and third order evolve, i.e. the system evolves, policy, technology, especially as a developer, you've got to figure out where the best use of capital is and the best execution capability is. And it was not an overnight success. There was lots of ups and downs in building that business. Anyone that looks at that business today would consider it like very successful, I think. But it's also, shows you that, you've got to have a little bit of a roller coaster ride appetite if you want to do tough tech, which is what we do. The other formative experience was an electric vehicle investment that I helped lead. And it was actually another mentor of mine named Lon Bell. Lon founded a company called Amerigon. And Lon, I think it was in the 90s, maybe early 90s, California had passed a law that kind of incented the growth of electric vehicles. Yeah. And then effectively repealed the law. And overnight, the case for his business from a policy incentive perspective was, and he pivoted the business to heating and cooling of seats. And it, again, shows that you have a core piece of technology, and a lot of what electric vehicles are is thermodynamic management, right? Energy management. And so he's like, I can do that in heating. And so most of the cars that people drive today that have heating and cooling of seats, Amerigon was the original, the largest scaled, or one of the largest scaled original companies in that space. And then he shelved the EV IP. Yep. And then one of his mentees and someone that worked at Amerigon started an electric car company that we backed. And we ultimately sold it to Mahindra. And I learned a lot I was very involved in helping with the IP committee, kind of helping with raising capital, helping with a number of things with Lon and the CEO there. And again, it shows you, one, the importance of thinking outside the box a little bit and the art of focus, because I always say focus, but in the sectors we cover in, we don't control.
Right.
We're dependent on policy. We're dependent on cost of capital. We're dependent on a channel that sometimes just doesn't want to take on anything new.
At the same time as Sanjeev is working with this electric car company, Tesla was also developing electric vehicles. Remember, this is early years for the industry, and Sanjeev is struck by Tesla's approach to battery development.
And this is where I really started to get my arms around systems thinking. Mm-hmm. And we had hired a lot more people from Detroit, which were very studied in sort of how electric vehicles should be done from a traditional OEM perspective. And Tesla took a totally different approach, and they took a more systems approach, in my opinion, which is really the art and science of studying second and third order. So we did 4 batteries, I think, more or less, maybe 6. Tesla, I'm going to get it wrong a little bit, but they had 10x to 20x the batteries, because they were putting batteries that were going into laptops and mobile phones, but certainly laptops at the time. And that was deflating, and both in availability and cost, and versus our batteries were not, because they were not scaling. And then what their art was, they stitched together, we had to stitch together 4 to 6 batteries, then they had to stitch together, significant more batteries, but they were able to do it with energy management systems. But it just shows you riding something that's a secular theme, that's systemic in another system,
right, and
colonizing that into your core product development. I actually have talked to people at Tesla after. That's one of the reasons they think Tesla sort of made it. It taught me really studying things out of your control, and where do you ride a wave and where do you not, both on the investment side, but also on the portfolio management side.
So many learnings from that time. I think at this time, you're also going through a bit of a boom and bust cycle in energy. So maybe you could talk a little bit about what you saw there and how it applies to what we're doing today.
Yeah. So I think I'm a veteran, for good or bad, of Clean Tech 1.0. And so I'd seen this movie before. But the confluence was never greater for that energy environment story than really this time between 2006 and 2011. Because you had, maybe for one of the first times, strong policy drivers because of 9/11, the desire for energy security. I think climate was becoming more topical. Mm-hmm. And then you had the 2 main candidates running for presidency, McCain and Obama, talking about cap and trade, which would have given a price on carbon. And even today, some sort of price on carbon is still sort of seen by many, many experts as the driver of systemic change. Now, I'm not sure we're going to get that, but it certainly was something that was on the table. So it led to a bit of a boom in both public markets. I think solar stocks reached their peak October of 2007. I think, I'm not sure that they've even returned to that level, although after the IRA, they may have come close. And then that boom happened, the election happened, and then there was no cap and trade. And then when that collapsed, in the Senate, a lot of the wind came out of the policy incentives. The second thing that happened is I think a lot of the investors in Clean Tech 0.0 did not think of it as tough tech. They consider it as traditional technology with capital efficiency, virality. And so it really influenced a lot, actually, for me. Because at the time at Global Environment Fund, I was doing energy, water, waste management deals. We were looking at even food and ag at the time, which was, again, early to do that. And it kind of made me think that a lot of those sectors are very policy sensitive. And I think it's one of the reasons I wanted to start in the food and ag sector was at the time, millennials were coming into their force, and the channel was certainly, particularly on the last mile of the food system, was open to new brands and new concepts. And so I was sort of like, well, a lot of this requires policy incentives, and the technology is not yet fully there. Obviously today, it's a different story on energy. And so I sort of starting to gravitate more toward things that were not as policy sensitive. Right. And certainly the consumer was changing. The channel for the consumer was changing. And I was really excited about going deeper in food and agriculture. The other thing I learned that I think is very important that we take today is really the importance of specialization. I was probably considered specialized, but I really learned you have to be really specialized, because the nuances of energy are so different than agriculture, which are so different than waste management, which are so different. And so this is the big lesson I took, was understanding what you're underwriting. And then 2, in order to do that, you really need to specialize. And then the second thing is you really need to bring value that is beyond capital, because I think capital in itself is the oxygen, but to get it from idea to infrastructure or from lab to the field, it takes a lot. And those are two big influences that I think we've tried to address here at S2G.
Yeah. At this point in his career, Sanjeev sees the power of consumer demand driving substantial opportunity for innovation in the food sector. He decides to shift his focus to food and agriculture investing and begins to explore that opportunity.
I'm like a big believer in karma, because you throw the world something and then it throws it back to you. I actually tried to start a version of S2G with someone that still I work with quite a bit in 09, 010. But we had 6 months ago at trying to do it. We thought we had some money from high net worths, and then in the end it didn't work, but you throw the world something. And then when Lucas, we had a common friend that really put us together that was really influential in helping also to do S2G. He connected us and we hit it off. And I think Lucas, is similar to me, had been exposed to energy, building for solar, had been exposed to broadly climate and energy environment, philanthropically, public markets, private markets. And so he also got the thesis around specialization. He'd also had a very emotional sort of upbringing in terms of how the food system impacted his childhood and his desire to bring that to others. And so we both on the mission side as well as the thesis side really bonded, and I think decided to give it a go. Kind of started talking in 2013 and then launched in 2014.
What was the original vision? How did you guys set out to define success in those early days?
I think it was those two things, helping change the food system and kind of looking at it as a systems investor as opposed to an impact investor. And then two, really making positive capital gains. And I also think because it was Lucas, we were able to look at things from a systems perspective and understand like second order, third order things, just like the Tesla engineers had done with the battery sector, right? And where do we play, where do we not play? And we really sort of were able to build a strategy that was much more about changing the system and not just making an impact. Yeah. Because those are two nuanced things. I think by changing the systems, like what are the theories of change? How do you then use that as a feedback loop to drive the rest of it?
You're teeing up my next question, which you've covered a little bit, but I think this whole journey of you working around the globe, seeing different experiences through the various energy cycles of boom and bust, and just having this experiences showing you how business can be a force for good, give you this sort of incredible way of thinking that I think is just really different than most people. I'd love to dig into that more and talk a little bit about how you apply that to what we're doing today.
I think of these, as you know, Tanya, as sort of commodity systems. The margin structure is commodity, the capital intensity is commodity, the channel is still anchored around commodity. For electrons, calories, water, energy density, which I think those are fundamentally the four things we do often. And in order to change those systems, make them, again, cheaper, faster, better, I think you need what I've seen in telecom, what I've seen in many sectors is really this combination of business model innovation and fit for purpose capital. And I think we are still in this first or second phase of this transition, because since I started this work in 2003 on the investment side, and even if you look at 99, 2000, the physics, the biology, the chemistry, and the computation have never been more invested, more progressed, more interesting. The business model innovation is still in its emerging phase of which business models will work. I think what is very much not yet been innovated on, and this is where I'd love talk about S2G in the future, is really this fit for purpose capital market system. Railroads had the bond market to finance it, right? Capital intensive. Even the telecom industry had junk bonds to finance it. Computation had venture capital, Fairchild Semiconductors and HP and all the things that Arthur Rock and some of the original venture capitalists, venture capital was artisanal. Today, it's the asset allocation of most investors that do alternative investing. And then, drug discovery, like starting the fact that you can take a phase 2B drug discovery company and have zero revenue, not know if you're going to have revenue ever because you may not get your regulatory approval, and get significant funding from the public markets. Right. Within tough tech, within these industries, we do not have a capital market system that is customized, that's financially appropriate from a structuring perspective, cost of capital perspective, risk reward perspective for these three transitions. Are some innovations happen? Yes, absolutely. But I think we're just in its infancy to do that. And that's what's exciting to me is if you have some productivity argument over the incumbent thing, and I saw this in telecom, saw this in vaccines, saw this in electric vehicles and solar as an example, there will be a business model to make money on it. And eventually, if you can't jerry-rig it from the existing financial system, you'll have to do financial innovation to really scale it. And so that's been, to me, frankly, the last 2 or 3 years of trying to understand sort of this anthropology of market change. And I think that's really the opportunity. It's like, how do you design that fit-for-purpose capital market system? And also show the world that resource productivity leads to capital productivity.
I mean, this is a perfect time to dive into S2G and where we're at in our journey. We've had 10 years of building this firm and team and successes over food and ag. We've expanded to energy and oceans. But based on that landscape and the need for fit-for-purpose capital, what is S2G's role, do you feel like, in solving this problem? And where do we play?
I think we play in all three. Obviously, we have a venture growth strategy. We have a credit infrastructure strategy. We also have done some joint ventures, or partnerships, I should say. And I think we've funded a lot of the biology, the chemistry, the physics, the competition, and those companies are making progress from a unit economic perspective and scaling P&L. And then we are also investing in that growth stage, which we've done for the last 10 years, of scaling business models. And some of them are business model innovation. Some of them are, effectively maybe existing business models that they're just better executed. And then the fit-for-purpose capital market system, we've done some work there, but I think there's a lot more you can do. I don't know if on the podcast we've had Justin on and talk about Clear Frontier.
Yeah, but we can do that.
But, that was the fit-for-purpose capital market system for regenerative organic agriculture and scaling that in the U.S. And we obviously saw it through our corporate development partners of that system friction need, saw a lot of second order, third order dynamics that said this should exist. And let's then design, though, a longer term partnership leasing model with farmers. And then let's take share risk with them. Let's do some business model innovation and some financial innovation. And now I'm really proud of what Clear Frontier is today in terms of their financial performance, the performance of improving soil health in our farms.
You've touched on this, but just to dig deeper, I think it's important to cover, why do we focus on the sectors that we do? So food and agriculture, oceans, energy. What technologies or trends do you see cutting across them? What was the logic behind going into these three spaces? One,
they're all commonly commodity-driven sectors, and they're fairly interconnected, in my opinion. All three represents our 90% of emissions, first of all. But two, there's a lot of opportunities for productivity gain, and they all three kind of operate with, again, commodity margin dynamics are similar, and the industry concentration is also quite similar. And then it's that second layer, though, of all of them are corporate knowledge, partnership with the oligopoly, and the incumbents are super important. And we've done that in food and ag, and now we're doing that in energy, and we're doing that in oceans. All of them are policy sensitive, so we have a policy group that we work with and are very close to us that understand that. All of them require some degree of thought leadership, convening, building that community. As you know, I've got this shtick on content, community commerce, the 21st century. And to me, the content is the argument, whether you're an entrepreneur, you're a CEO, you're an inventor, you're a capital allocator, but you need to build that community of early adopters, people that take the baton from early adopters, and eventually the ones that are eventually converted from the skepticism of all this. And then the commerce is just the outgrowth of content and community. And the argument often involves hopefully a product or a service, not just a thesis. And that's what we've been building. And I think that's what helps get adoption and scale in these markets. Not everyone can be an Elon Musk. That's a rare occurrence to change multiple sectors. You need to have a systemic, structural process approach. And I think we're trying to design it based on our three industries. As we enter this next decade for S2G, what are you most excited about going forward? Where are you leaning in? This is my third, because I don't think COVID counts as a bear market. I went through the .com boom bust 08, 09, and then this. COVID was like 2 months. And then
And then the scope of that journey.
yeah, changed. And so this is my third cycle, and I think for Chuck and Aaron as well. It's really like in our current portfolio, just making sure we build real businesses with real margin and EBITDA, and then effectively, once a market comes back, provide exits for investors. I think the next couple of years are going to be great times to invest, actually, and build real companies that have proven themselves. So I'm excited to build the companies that we have in our portfolio, find new companies to help build. And then third is really work with the ecosystem around this fit-for-purpose capital market system that both hopefully help our existing portfolio companies and new portfolio companies, but also maybe launch some ships or boats.
You've seen so much through all those transitions. What do you think is really different now with impact and environment-focused investing versus what was the case over the last 20 years?
It's a really good question because to me, the most important force in capitalism aren't shareholders. They're consumers.
Yeah.
And there's a new generation of consumers, millennials, Gen Z, what's behind them, that really care about this more than I've ever thought. It actually gives me a lot of hope. And so I think that's really a good anchoring point. The second is, I think, capital and this new generation of wealth is interested to allocate capital that has a purpose for what it does. So I think capital is flowing here. I think third, and it's really government, academia, scientists, entrepreneurs, inventors, the biology, the chemistry, the computation, the physics of calorie production, electron production, energy density production. I've never seen more exciting things that get us closer to that cheaper, faster, better. Some of them are already there, and some of them are en route. And then the fourth is really the entrepreneurs, the management teams that we're finding. I was just with our colleagues yesterday reviewing the pipeline for this year and next year in terms of companies we're looking at. It's just really exciting companies. Some of them have been just bootstrapped and never had any money. And so I think that's going to be interesting as well. So I think there's a lot of just structural forces. The one that I think will go up and down is policy. You look at outside the U.S., the policy incentives are clearly going to stick, particularly in Europe and certain other markets. And I think, again, my lesson learned is don't underwrite the policy incentives. Yeah. And so I think even we'll be prepared for whatever policy dynamics and volatility come. Yeah. But I think in the arc of this, it's not just about the environment. It's also about security, self-reliance, and a lot of these other things. So I still think the policy incentives will be there, especially if you create jobs and wealth and are productive. I don't see the policy tailwind or headwinds being as significant.
Just stepping back and thinking about what our listeners can take from this discussion, can you share a bit of advice for other business leaders or investors who are listening? You've had an amazing journey from starting off in India to now being on the stage at COP and in a very influential room. So what can we learn about your journey?
I mean, I think, one, you're going on this journey for forever until you die. I think, just always learn, I guess, and have a growth mindset. I think one that I've learned is specialization is really important. And then also taking that specialization from a systems perspective and really understanding the overall system, including the incumbents that have the majority market share of that system. Yeah. And be humble to what they've built. I would say expect it to be a long cycle. If you are getting comfortable with that up and down of that cycle, I think one is don't be afraid to pivot. You don't always control your destiny in these capital intensive commodities, sensitive industries. The markets control it. It was over the weekend, someone said, if the winds shift the sails. And the wind's always shifting. And then be prepared and patient. I think the prepared part is when you've got an opportunity to find an IPO or an M&A, do that, but also be patient. So it's this combination of being ready when the window opens, whether it's product market fit, channel acquisition, scale, eventually exit. So I think those are the lessons learned I've done. And probably if you ask me back every month or year, hopefully I have more lessons.
Anyone who has met Sanjeev and worked with him for any significant amount of time will know that he has a number of sayings that sum up some of the lessons he has learned throughout his career and his point of view on investing. One is circle, circle. What does it mean, Sanjeev?
It's the, again, art of focus and the art of patience. Sometimes, the deal you don't do is sometimes the best deal you do. And sometimes having patience for understanding a sector, a subsector, a company, a set of companies, and then going in at the right time. Yeah. So to me, it's maybe the art of timing.
Got it. Okay. Next one. Riches are in the niches.
That's someone else that maybe listens to this podcast that gave it to me. But I think if you're trying to make a big influence, you can't start wide. And so, like, I love niche businesses that can grow into something bigger, but they have this initial entry point, starting out small and then growing bigger. I really like those businesses.
Okay, the ecosystem of ecosystems.
I think it's sort of this notion that in tough tech, it's not as easy as being two people in a garage and selling code and automated math that eats your lunch. Like, it takes a village to cook the lunch, and you have to figure out where you fit in these large multi-trillion-dollar steel, cement, whether it's a tractor or a power plant. And so I think you've got to figure out the broader ecosystem and how you engage with it.
Plan A, Plan B, Plan C. That one's more straightforward, but still give us your background.
I'm not a burn the boats and do one thing because, again, the winds constantly shift. You're a small or medium-sized boat. And so you've got to figure out different multivariant approaches to problems. I always think of business as a set of problems. Yep. If you solve enough problems, you make money. If you don't solve problems, you don't. And so I don't have one approach to problem solving. It's like, all right, just let's assume the winds change constantly. It's not for everybody. And it's not for every situation, but that's sort of a philosophy.
Nice. What other quotes or philosophies did I not mention that you would like to flag for us?
I think the one that, I think we've been doing it, but I think we always need to continue is if we're the smartest person in the room, we're in the wrong room. I always think of this job as investigative journalism, and maybe it brings all those quotes home because circle is like, all right, do you really know enough about that industry, that sector, that company? Let's get to know it. And like the best preparation for this job is investigative journalism. Because all the other stuff you can learn in business school or you can learn on the job, but that curious mind and to sort of keep uncovering. And I think, often that process is a process of listening and learning and discovery, and it's sort of how wrong you are.
What do you love most about your job today?
I think when I see like real scale happening on one side, and then two, when I see some changes happening with a sector, a subsector, and the third is that community that we're building and kind of growing it. And I think that's one aspect. The second aspect is sort of our team that's grown. I think we were like 3 or 4 people, and now we're over 40. And the passion they bring to it, the knowledge they bring to it, the specialization they bring to it. And so I keep learning from them. Amazing. And the third, and probably the most important, is the front lines of the people doing the work, our management teams, our entrepreneurs. They're doing something that is, frankly, probably adjusted irrational, but they hope that they're doing it for a purpose. They're doing it because it is the vehicle for change, I think companies are. And they're trying to build products and services that both have shareholder value and systemic change.
Amazing. Thank you so much, Sanjeev. It was a pleasure. It has been an incredible journey since Sanjeev and Lucas put ideas to paper 10 years ago. We will also continue to explore these themes in future episodes. Sanjeev will be in conversation with other investors and business leaders to dive further into systems thinking and the opportunities at the seams of our sectors. And to close us out, here are a few of those Sanjeevisms.
Plan A, Plan B, Plan C. Boom. Flywheel. The ecosystem of ecosystems. Cheers, cheers, cheers. Love Mummy, Daddy, and Damien. Circle. Out of money call option. Deflationary. Structural versus cyclical. A horse by committee. ... A camel.
Thank you for tuning into the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out S2GVentures.com.